Well, good evening, everyone. For those of you attending, since you guys got in early, I'm going to give you the opportunity to ask me any questions that you might have so far on the material. Just go ahead and unmute yourself if you have any questions to ask. Well, no questions. All right. We're about 2 minutes away from starting. I want to give the rest of the folks a chance to come on. 1 minute away from starting. So I guess we'll go ahead and get started. Probably won't have a lot of people on tonight since we're in playoff season going into the Super Bowl. So, but just remember that all these videos for these study groups are posted online. I try to get them up on Monday. If there's a glitch, sometimes it'll be a Tuesday, but if you subscribe to the YouTube channel, you should be alerted each time that a new video goes up. And there's old videos up there too. What I did is the lecture videos from last semester that I did are up there for each chapter. So it's good to if you're having problems with SmartBook, go up and view those. And then you can go ahead and review the study group videos, because mainly I'm going to go over problems in these so you'll understand how to better do the homework and do the quiz. I want to remind everybody that you get 2 bites of the apple on the quiz. So if you don't like your grade, so let's say you get a 60 or even an 80, I don't care. Send me an email and I'll show you what you got wrong. So next time you can go in and do the second attempt, you can improve your score. You're going to get the higher of the 2 scores. So the other thing too, where it helps you is at the end of the semester, sometimes you might be a point to half a point away from being bumped up to the next grade level. And I go back and I look at your history and I see where you majored 2 attempts at quizzes. Sometimes I've had students that put a lot of work into practice problems. Now that's not required, and I'm not trying to encourage you to do that, at least until later in the semester when you're studying for your final. But understand that I do go back and look at what you've done in the past. If it looks like that'll help you out, and a lot of times I can give you points where I see that you made the effort, okay, and where you've gotten it right in the past. So enough said there. The other thing too that I want to go over with you is I can't get to all the problems. All right. So if you're doing your homework and you get stuck on a homework problem, email me and I'll try to help you with the solution. Okay. So that's important as well. All right. Okay. So what we're going to do, let me bring up and share my screen with you so we can start going through. These homework problems. Oh, come on, screen. Where are you at? Bear with me. This thing is hard to navigate sometimes. Okay. Oops, I selected the wrong one. There we go. Okay. So what I'm doing is going through practice problems. Your homework problems are by and large identical to your practice problems. Now there's more of them. Okay. So what you're going to run into is maybe there's a problem in homework that I didn't get to cover in the study session. But that's all right. Again, you can email me if you like. I can see that my teaching assistants are knocking at the door already. I have a 120-pound Great Pyrenees who knows where the treats are, and they're about 10 feet away from me. So if I have to interrupt this, I apologize. So anyway, as I was saying, that if you look up here, and I hope you can see me highlight at QS 2-2. In the back of your book, you'll see there are problems, and QS stands for quick study. EX stands for exercise, and I think PR for problem. And these are all out of the back of your book. What they do is they come up with different data. So there's an algorithm, and This way, no two students, when you get into graded items, will have the same numbers and all that. But the practice problems will have the same numbers for everybody. And I like doing these in class because everybody can follow along easily. What you might want to do is, if you email me, I don't need screenshots, okay? So don't send me screenshots. All you have to do is put this QS2-2 in if that's what you're having trouble with on the homework or quiz, and I'll look that particular number up in your assignment. I had a couple of students reach out to me today that were having problems, and I just went into their quizzes and their homework to see what they were having difficulty with. And so I was able to pull up the problem and send them the solution that hopefully helped them out as far as getting to the correct solution. Okay, so the first problem you're going to run up against is identifying financial statement accounts. Now, this is what you need to do in this chapter, is try to know the accounts as best you can. Every time there's a transaction, two accounts are affected, two or more accounts, I should say, are affected. Now, we're going to keep it simple in the first couple of chapters where it's usually just two accounts. But by the time we get into chapter 5 and 6 and 7, you're going to have multiple accounts affected. You may have one debit and 3 or 4 credits. Okay. As long as they balance out and equal each other at the end of the transaction, you know, you've probably done it correctly. Right. So in this one, we're going to identify whether or not this is an asset, liability, or equity account. Cash is an asset account. Prepaid rent. Remember I said last week, if something is prepaid, that's an asset. So this is an asset account. Office supplies, also an asset. Okay. Now, we may have office supply expense when we calculate exactly how much we went through in office supplies, but when we buy office supplies, it gets debited to this account, which is an asset. All right. Prepaid insurance. Again, that's an asset. That was one of the keywords I told you about. Office equipment. Again, it's an asset. Notes payable. Remember, anything with payable at the end is a liability. So notes payable is a liability, and accounts payable a liability. Unearned rent revenue. What is unearned revenue? Okay, this is where you've been paid in advance for a product or a service. Best example is magazines. Although magazines seem to be going away, and I have a lot of students that don't really know what they are, I'm learning. But used to be, Publishers Clearinghouse was big on selling magazines by getting you to enroll in their sweepstakes. And so you would get something in the mail, and you would get to select up to like 12 magazines for $1 a month. Literally $1 a month. If you look at magazines now, they can be $10, $15. But they let you subscribe for $1 a month. Well, you haven't earned anything when you mailed them a check for $12 to cover a year because you haven't received any magazines. So the company has to put that into unearned revenue, and that's a liability. So the key word unearned means it's a liability. Why? Because you owe that client money. That's your client's money, not your money, until you send them a magazine. Okay. Notes receivable. Remember I said anytime you see receivable, that it's going to be an asset. Okay. Let me explain why. If you have a note that says somebody owes you money, you can take that to court. You can take that to the magistrate, and that magistrate may even, depend on the laws of the municipality or state, be able to garnish your wages to get your money back that you lent somebody. So for that reason, or you can take it to the bank and sell it to them. You usually get about 70, 60 cents on the dollar, but you can sell it to them and then they'll go after it like a collection agency. So that's an asset. Any questions on any of those that I've gone over? Okay, I'm going to move forward if I don't hear anybody coming off mute. Let me see if we have anybody else join. Nope. Okay. All right, next. Reading the chart of accounts. Now, all these accounts, all right, when they're listed and organized, it's called the chart of accounts. So for instance, if you go out and get QuickBooks, right? One of the first questions they ask is, please review the following chart of accounts and see if you're okay with it. Or no, I think what it is, I'm sorry, what it's really worded like this. You have to state what your business is, and it pulls up a sample chart of accounts based on what other companies in the industry do. And it's pretty lame, let me tell you, because for our clients, we usually have to go in and add a bunch of accounts that aren't there. But anyway, this chart of accounts is what is a listing of where you're going to park everything. Okay. Like for instance, right now we're finishing up a lot of clients, their books for the year, and some of it's pretty straightforward. We can program QuickBooks to every time they pay, say, do power, QuickBooks automatically puts it under utilities, right, which is an expense. But there's some things where they write checks and we have no clue where this money went. We don't know what this person does that the check's written to. So we have to call the client and say, what was this for? And they'll say, well, it was for advertising, or it was for a repair, or it was for rent, et cetera, et cetera. Okay. So what we want to do here is, again, we have to identify the accounts as either asset, liability. Here we're expanding equity into revenue and expense. And maybe this will help some of you in understanding what revenue and expenses are. Okay. And so let me give you an example first before I go through this. Let's say you have a bookstore. Okay. And in this bookstore, you have a break area where you have snack machines for your employees. And you have a shed out back, a fairly good shed, small warehouse type shed that you rent out to your next door neighbor who has a hardware business because he's got too much, he doesn't have enough storage. So you've agreed to rent it to him. You have three different kinds of revenue. You have the books you sell, which is sales revenue. You have commission revenue because you're going to get a commission from Pepsi and Lance on what you sell in those machines in the break room. And you're going to get rent revenue because your neighbor's going to pay you monthly for letting him use your building for storage, right? Those all get listed first on the income statement. All right. Revenue is at the top. Then you list all your expenses like utilities, salaries, office supply expense. I think of some others, fuel, if you have vehicles, and on and on and on. Okay, there's typically a typical business that I do books for has from 20, 25 expense accounts because they have that many types of things they're spending money on for expenses. So first expense, that's a good one, advertising expense. Remember, anything with expense at the end is an expense account. So we're going to put that under expense. Where is it? Here we go. Rent revenue. Remember I said any time someone's paying you for services or for rent or for a product, it's going to be under revenue. Okay. Rent receivable. Rent receivable. Okay. Now remember, receivable is an asset. All right. So because it's got receivable at the end. This is where somebody owes us rent and we're fixing to collect it. So that's an asset. Machinery. Machinery is an asset. Anything that we own, remember, assets are what we own, liabilities are what we owe, equity is the difference between the two, and it can be positive or negative. Here's accounts payable again. We know that it's because it's a payable, it's a liability. Furniture is an asset because we own it. Oh, went the wrong way on that. Notes payable, again, payable is liability. Prepaid insurance. Now, let me explain prepaid insurance. So businesses, well, I guess individuals do this too, because you're going to pay 6 months in advance sometimes, or a year in advance for an auto policy if you're not on a monthly payment plan. So let's say you go out and you buy an insurance policy for a year. Well, you're going to write that down 1 month at a time. So in January, you're going to write down 1 month of insurance, that becomes an insurance expense. But everything else, the other 11 months is prepaid insurance. Remember I said prepaid is always an asset. And so that's going to be an asset. And utility expense, got expense at the end, so that's going to be an expense. All right. By the way, be careful, and I'm going to show you some quiz questions tonight that may trip you up. Okay. And so I'm gonna try to prepare you for that, because it's not so bad in the homework, but in the quiz, they love to throw stuff in there that has nothing to do with the question, just to see if it'll mess you up, which I don't particularly like, but I didn't write the textbook. Next, identify the normal balance for each of the following accounts. Now, a lot of people like, for the first time learning accounting, to make a debit a plus and a liability minus. That should not, you need to dispel that from yourself right now, because whether you add to an account or take away from an account is going to depend on what the normal balance for an account is. So if something is an asset, we all know what we should know what that is by now. Looking at this chart, office supplies, cash, prepaid rent, building, these are all assets. So the normal balance for those assets is a debit. When we increase those accounts, we're going to debit those accounts. If we decrease those accounts, that is contrary to the normal balance. So we're going to subtract from those accounts. Now, when we go over to the liability side, now we're looking here, we can see it's, let's see, wages payable, unearned revenue, wages, well, not wages expense, that's different. For those two items, it's going to, the normal balance is a credit. So if we increase our notes payable, or if we increase accounts payable, in other words, if we increase how much we're buying on credit for ourselves, then that's going to be a credit. And if we're paying off those bills, okay, which decreases those accounts, that's going to be a debit. So that, understand that how you handle increases and decreases in these accounts is you have to know the normal balance. So you have to know where the accounts fall, like office supplies is an asset. Asset, the normal balance is a debit. So we know if we're bringing in more office supplies that we're going to be debiting that account. If we're using up those office supplies, we're going to be crediting that account. If we are running up a lot of bills, let's say it's the beginning of the week and we have a restaurant, we're ordering food, but we're buying on credit, we're going to see our accounts payable go up. So that means we're going to be debiting those invoices. I'm sorry, crediting those invoices. And as we pay them off in the following week, we're going to be crediting those accounts. So try to learn what your normal balance is for these different accounts. One thing I didn't mention was the income statement item. Revenue, the normal balance for that is a credit. For expenses, okay, the normal balance for that is a debit. If you think about it, that makes sense. Okay, because these really fall under equity. So if you are increasing your sales, you're bringing in more money, that money is making you wealthier, which increases the equity or your ownership in the company, right? So it would be a credit. Now, when you write those checks from cash to pay those bills, well, that's lowering your equity. All right, it's dropping your equity because you own less than the company because you have to pay bills. Cash is going out. All right. And so that's, so that's why it's a debit. So let me go through here real quick. And revenue is a credit. This is a debit. Cash is a debit. Those are assets. Wage expense. Remember I said expenses are debits. And by the way, as we go through the semester, if you have trouble wrapping your arms around it, don't get frustrated. All right, because you'll see in a couple of weeks, this is all you're going to have your aha moment. All right. And it's all going to make sense. And it's all going to come together. All right. Accounts receivable is a debit because it's an asset. Prepaid rent is an asset, so that's a debit. Wages payable is going to be a credit because it's a liability. Building is an asset, so that's going to be normal balance as a debit. And unearned revenue is going to be a credit because it is a liability, right? Not because it has anything to do with revenue up here. It has to do with the fact that we park it as a credit until we go and we capture it under revenue. And hopefully we'll have an example of that tonight. If we don't, there's an example in my chapter 2 video that's up there that you can see. Linking debit or credit with normal balance. Indicate whether debit or credit decreases the normal balance, right? So here we have interest payable. Remember, payable is a liability. Now we need to decrease the liability. So to decrease a liability, it's a debit. So that's the opposite of a credit. Normal balance is a credit, okay? Accounts receivable, this is an asset. Normal balance is a debit, but we want to decrease the account. So we have to credit the account when we decrease it. Prepaid insurance, again, it's an asset. I need to check. Oh, I am recording. Good. I thought I might not have started recording again. Prepaid insurance, again, it's an asset. So if we're going to lower that, which we're going to do every month when we have to show what we used up in insurance, that's going to be a credit. Buildings is an asset. We sell a building, we lower that account. We no longer have, let's say we own 5 buildings, now we only own 4. So when we sell that building, we're going to credit that account for the cost of the building. Accounts payable, that's a liability. So if we decrease the liability, what are we doing? We're paying off the bills that we owe. And so when we pay a bill, we're going to debit that account. And then land is an asset. So if we sell say we sell some land or all of our land, we're going to credit that account to show the decrease in. Again, if I'm going too fast or if you have any questions, feel free to stop me. In this one, we have to identify whether a debit or credit results in the indicated change for each of the accounts, all right? So if we increase land, that's an asset, right? So the normal balance is a debit. We're going to debit that account. I'm only going to go through half of these so that we can move on because we're already used up 2/3 of our time. We're going to decrease cash. Now, what's cash? An asset, right? So we're going to credit cash. Every time we write a check or we pay somebody, we're going to debit or we're going to credit cash. Increase consulting revenue. We've got a job that we did and we have to capture the revenue. So we're going to credit that account. And here's the thing, students get confused with revenue and cash. Don't, okay? Let me give you an example. We're going to learn that in starting this chapter that we're going to be doing journal entries. So if we go and we get paid for a job that we did right away, that's going to be a debit to cash and it's going to be a credit to revenue. But it affects both accounts, but they're recorded differently, okay? We're going to increase our salary expense. We had to pay payroll this week. That's going to be a debit. We're going to decrease unearned revenue. We sold some magazines this week, so we have to decrease unearned revenue, which, by the way, it's going to be a debit because it's a liability. When we decrease a liability, it's a debit. What do you think we're going to credit? Well, we're going to credit revenue because we're moving it from being prepaid. Can't capture the revenue because we haven't done anything yet. Remember our principles that we learned in chapter 1? So we're going to debit unearned revenue, and then we're going to credit revenue, magazine revenue, I guess you could say. All right. All right, I'm going to stop here for a minute. One other thing I wanted to add here. Well, I've lost my train of thought. It'll come back to me because we're going to have to. Oh, I know what I was going to say. Always list when you do the journal entries in your homework and your other assignments. Always list the debits first in the journal entry, and you list the credits second. Okay. Debits always come first, and then credits always get listed. So you're going to list the accounts that are debited, and then you're going to list the accounts you're going to debit. Now, we're using T accounts to keep track of transactions in this course. And the reason for that is we don't have the ability to do a bunch of ledger entries, okay? Picture a, well, some of you may have seen a column, it's hard to pronounce, a book with a bunch of columns in it, all right? Those are called ledgers and journals, all right? You have the journals to record the transactions. Then after you record the transactions, you got to move what you did in each account into a ledger. So you're going to have a cash ledger that shows every cash transaction. You're going to have an asset ledger that shows every asset, every time you bought something that what came in as an asset, and every time you sold something as an asset. You're going to have a ledger of accounts payable. All right. Those accounts payable are going to be every time that you buy something on credit or pay off something you bought on credit, etc. If you want to visualize this, think about one of these rental places like Aaron Rents. I think they're still around, or Rent-A-Center. All right. They have to record every transaction when they sell something on credit, because every rental is really a credit sale. So you got 1,000 clients. You're going to have 1,000 ledgers, one for each client, that you have to aggregate up into that accounts receivable account. So we're going to use T accounts because it's easier to keep track of. Okay. And I'll just pick out one here. Okay. Accounts payable. You got to come up with the correct amount, what the current balance is. So if you look at your debits on the left, you've got 4,700. And you've got a credit of 8,000. So that gives you a credit balance of $3,300. And you're going to put that right here on the credit side. Left-hand side's for debits, the right-hand side's for credit, okay? Here, under accounts receivable, we have a $50 balance. We started off with $600 in what people owed us, and they've paid off $550. So we have a balance of $50. We're going to put it on the debit side because the normal balance of this asset is a debit. Okay. So when you have a problem like this, understand that you've got to post on which side that the normal balance is. Now, let me tell you something. You're never going to go below zero on any of these. So if you overdraft, let's say you overdraft your cash account, all right, and you only had $50 in there and check was cashed for 100. Well, you're going to bring that down to zero, but you still got $50 left. What do you do with the 50? Well, that becomes an account payable. So you'll post the $50 under accounts payable. You'll never run any of these accounts down to less than zero. That's just an accounting rule. All right, now we're going to start doing some entries. So in this first transaction, the owner invests $6,500 in cash and $3,500 in equipment in exchange for common stock. In a way, they don't give you all the information in here. You got to figure out the last part. So the first thing I'm going to select, and these are both debits in these first two amounts, so I'm going to have to select the debits first. And let's see, what was that? Oh, there it is, $6,500 in cash. Where did cash go? Oh, there it is. Okay, and then we're going to put 6,500 there. Next, we got equipment, so that they're putting into the company. Very common, by the way. 3,500. Now, I've got $10,000 in debit. I need a credit on the other side to make this balance, because you always have to balance your debits and credits when you're doing a journal entry. Very important. I see students all the time, they're like, we're going to have an accounting cycle problem that's going to be due in a few weeks. And they skip the steps, they don't take the time to sit there and say, well, I don't know what I did wrong. Well, you didn't add up your debits and credits to see if they equaled each other. It's obvious. So here, I'm going to go ahead and select common stock. And I'm going to put 10,000 over here. Okay. And both sides are in balance. So we have a correct answer. Number two, the company acquires $2,000 of supplies by paying $500 in cash and putting $1,500 in on credit. So the first transaction is going to be the supplies, which is an asset. Come on, where are you at? There you go. All right. So we're going to put $2,000 there. Oops, not one too many. All right. Next, we have two credits. Our first credit is cash because we paid cash. Because we lowered cash by $500 by writing a check. And then the second transaction that's a credit is accounts payable. And that's $1,500 because we still owe $1,500 for the supply purchase. Okay. And so, and let's view the general journal here and see what it looks like. There you go. And that's what your answer should look like. Okay. Let's see. Now, we have to indicate which financial statement each of the following items appear, whether it be the income statement, statement of retained earnings, or balance sheet. Okay. So, service revenue goes on the income statement. I'm going to go down and I'm going to select all the revenue. Here's one, rent revenue, that goes on the income statement. Unearned revenue does not, and I can't tell you how many times I see students try to put it there. It's not revenue until it's earned all the time. Okay, there's no exceptions to this. So it's always going to be a liability. All right, and that's going to go on the balance sheet. Interest payable, balance sheet. Now you're going to have interest expense, but that's not what this is. This is interest payable. This is, we've borrowed money and we owe interest to someone. And it usually comes about at the end of the year because the contract that we use to borrow, it does not require that we pay it by the time the accounting period is over. We'll see examples of that later on. Accounts receivable is an asset, so that goes on a balance sheet. Salaries expense, that goes on an income statement. That goes below all of your sources of revenue. You're going to take your revenue and add those up. Right? For most of the work we do, it's only going to show one type of revenue, which is sales or something like that. But in some examples, it'll have a combination of revenue, like the one I told you about at the beginning of class. So if you have more than one source, you got to subtotal that before you finish the income statement. And I say that because a lot of students will email me saying, I got 100 on the problem, or however many points that they award, but it says it's incomplete. Well, it's usually because you didn't subtotal and do the drop down box that says total revenue. Okay. All right, salary expense, that's an income statement item. Equipment, that is a balance sheet item. Prepaid insurance, a balance sheet item. Buildings are a balance sheet item. These are all assets. Office supplies, balance sheet. Interest expense, that's a income statement item. Remember, and whenever you see the word expense, it goes on the income statement and gets subtracted from revenue. Okay. All right, here, let's see, we have to the first one, QS 2-14, prepare a trial balance. All right, what a trial balance is, and I've explained this in the video, but I'll go over it again briefly. What you're going to do is you're going to list all the accounts, starting with the balance sheet. Then you're going to put in the income statement. And what you're going to do is total up your debits and credits to make sure they equal each other. It's the first step of making sure that you're getting ready to close out the books. And when I say close out the books, prepare the final financial statement for closing out a particular month, a quarter, or year. Okay, so the first item is going to be cash. And I'll tell you, early on, they usually put this stuff in order, so they make it a no-brainer. Yeah, you got accounts receivable. Let's see, equipment. You see them just copying from up the top. Yeah, they put them in perfect order for you. Okay, so those are the three assets, and we got 5,000. Let's see, 4,500 and 6,500. All right, next we have liabilities. Well, look at that. They put them in order. You got one, accounts payable. So we select accounts payable, $3,000. All right, and next is we continue. The next balance sheet area is what? Equity, right? So we're going to put select common stock. That happens to come to 10,500. Now, see what it's doing down here? It is totaling both sides as we go along, because by the time this is over, both these numbers should be identical if we did everything right. And if we didn't, and you got to go back up here because you made an error carrying it down. Next, we have dividends, and we'll get into dividends in later chapters. Explain what they are. Don't worry about them right now. Just do what it says. Normal balance for dividends is a debit. Until it gets paid out. Then we have service revenue, which is service revenue, which comes to $12,000. And then we have our expenses. So if you can see, they got them in order up here. You can just go through this thing in order. And that's the way most of them are, I think, in chapter 2. And I believe in chapter 3. They start to mix them up in later chapters when we start to nail things down. So we have rent. And we have wages. And normal balance is the debit, right? Let's see if we're in balance. How about that? Look down here. We came out exactly in balance, 25,500 on both sides. Debits have to equal the credit. So we have successfully completed the first step of a trial balance. Now, don't get too comfortable, because some of the trial balance problems you're going to be working have 3 times as many accounts that you're going to have to balance. But I'll let that scare you. It's just a matter of being careful and carrying the items down correctly. Let's see. Next, you have to prepare an income statement. Okay. So now, here's what you got to remember. When you're preparing financial statements, you do the trial balance first. Next, you have to do the income statement, because you can't close out the business unless you're able to put how much profit you made on the final balance sheet. So you're going to do the income statement, then you're going to do the statement of retained earnings, and then you're going to do the balance sheet. And you'll see why when we fill these out. So take them in order. Just be diligent and careful that you're doing them right. Okay. And you'll come out with the correct answer. So on this one, we have service revenue. Let's see what this options are. revenue. Okay. We have service revenue. 12,000. Nope. And these are not debit and credit columns in this. All right. I got to point that out. This is the first column is your where you list the items. Second column is your subtotal column. Okay. That's going to be a little bit different than doing general journal entries and posting to the different accounts. So don't let that confuse you. The service revenue is 12,000. Then next we're going to drop down here to expenses. And let's see, first one's wages, I think. And what's the other one? Rent expense. If you check that, please. Yeah, okay. Well, all right, 2,000, 6,000. Don't think it'll make it wrong if I put those two out of order. Shouldn't. And then again, remember I said you got to make sure you do the drop down. So down here, you're going to show a net profit or loss. It just so happens we're going to have a net income or net profit. They mean the same things. Don't get hung up on that. We subtract 8,000 from 12,000. That means we have 4,000 left over. That's our profit. That's our income. And that's the number we need to complete the next step, which is the statement of retained earnings. You don't do all this, you're not going to know what that number down there is. We don't use the house fund for anything, so that is probably a market. All right, next, prepare the statement of retained earnings. So in doing that, you select this first box, all right, as of, let's see what the problem says, December 31st. Let's see. Oh, for the month of December 31st. Okay. There's a difference there. If it was ending December 31st, it'd be for the year. It says here we only want to do a month, okay, at a time. So first one is we have to put in the retained earnings on December 1st, which is the beginning of the accounting period, and that is 0. Next, we have to put in the net income. And that is, if you recall, $4,000 up, gives it to us up in the problem, all right? Next, we have to put in the dividend, because here's the thing. We have to pay out those dividends when we close out the books, all right? Those dividends, the way dividends work is this. When you go out and buy stock, right? Most people want to share in the profits of the company. That's why they buy the stock. Now, some companies don't pay dividends. They count on you being happy with the stock price going up, all right? Many, many years ago, Microsoft was accumulating cash like you wouldn't believe in the late 90s. And they were using it to buy out other companies, but they didn't want to give it up. And the shareholders got mad because the stock price wasn't going up. So they couldn't make money on buying and selling the stock. And yet the company had billions of dollars in cash just sitting there. So they actually had a shareholder revolt at one of their annual meetings. And ever since then, Microsoft's been paying dividends, just like other big companies are that are called blue chip companies. So what dividends are is at the end of the year, sometimes 4 times a year, it depends on when they paid out dividends. The board of directors gets together and decides, what are we going to share with the owners? And that's shared through dividends. So they'll say, we're going to pay out 50% of our profits in dividends. And I'll get into dividends a lot more when we get into chapter 10 and 11. But suffice to say for now, these things, it's kind of set at that point what they're going to pay out. So they make that a liability. Once they decide, it becomes a liability because they've decided to pay it out. And then when they actually do pay it out, that's when you're going to lower the dividends. Well, in this case, the dividends came to $1,500. All right. And that means that our retained earnings on December 31st are $2,500. What are retained earnings? Well, the word retain means keep, doesn't it? Earnings are profits. We're keeping our profit. We're keeping $2,500 in profits. That's just a good way to remember what that line stands for on the balance sheet. And hopefully, if you're a growing company, this number is going to go up every year. Right now, December 31st is $2,500. Okay. Let's see. Next. So now we got to do a balance sheet. All right. And I'm going to skip putting in all the assets and liabilities. I'll just show you the equity section because that's where the difference is going to be. So you got common stock, 10,500. Trust me that when you put in all the rest of this, if you do the retained earnings right, carried over right, you're going to be fine. Let's see. Retained earnings will be, what did I have, 2,500? Okay. And that's essentially, this is going to be total equity. And this is going to be total liability and equity. All right. But everything else is you're just carrying down what's up here and putting it in. This is how you'll fill out this section right here. And once you've done that, this balance sheet is ready to publish as what the company owns, owes, and what they're worth at the end on December 31st. Any questions on this? Okay, well, I haven't lost anybody yet, so I guess that's a good thing. Now we're gonna get ratios every week. Okay, and this particular one's the debt ratio. And the debt ratio is showing that for the current year it's 61%, a year ago was 45%, 2 years ago was 37%. Question asked, is the risk increasing or decreasing? Well, it's obviously increasing because you're carrying more debt, and the more debt you carry, the harder it is to pay it back. So debt ratio is going from 37% up to 61%. You have definitely increased the company's risk. This is, let's see, you got total liabilities and total assets. So you have to complete the debt ratio. It's just math is all it is. And so you divide the liabilities by assets, and that gives you a percent. Now, I don't have a calculator handy, so I'm not going to calculate this, but this is pretty straightforward. We shouldn't really have to go through this. Just do the math. If the number comes out bigger, then you know that it's worse than the competition that it has there. Oh, don't lock up on me now. Okay. Locks up on me from time to time when I'm in student view. Let's see. Gotta figure out how to get there. Let's try up here. Yeah, there we go. All right, and then finally, steps in analyzing and recording transactions. You got to put in order. In which order are you going to run these reports? Okay, so first, prepare and analyze the trial balance. That's number one. Number two is you got to prepare the income statement. Oh, wait a minute. No, I take it back. This is going back to when you first analyzed the document. My apologies. So the first thing you're going to do is you're going to post into the journal. All right. Then you're going to post. Oh no, I take it back. This is terrible. I shouldn't be this confused on this, but here we go. First, you got to analyze the transaction because you might not have a transaction. Okay. I'm sure you've seen that in your smart book. All right. Next, step two is you're going to put them into a journal. Step three is you're going to post to the ledgers. And step four is you're going to do your trial balance. I didn't want you to save it anyway. Okay. So step one, analyze the source document. Step two, jump to the next question. Oh, well. Let me go back. This gets really squirrely in student view as I get to the end of the practice problem, so I apologize. Number 16, we're not going to go through. It's going to take you through, really, it's kind of a mini accounting cycle problem. Accounting cycle is going to be coming up. Well, I'll go over that in a future video. I'll probably do a separate video on that, or I might do a separate study session. I haven't looked at your due dates for chapter 2, but I suspect we're going to have about 2 weeks to get the assignments in. So since we've covered chapter 2 by the end of this session, I might go into the accounting cycle problem next Sunday. And here's the thing also, make sure you go in and look at the accounting cycle problem. If you feel comfortable starting it, definitely start it. It never fails that every semester I'll have students, no matter how much I warn them, I'll have students go in on the due date with 3 hours left on the clock. It's just not enough time for those kind of students to get it done. Some students that have been keeping up with the work all semester, not a problem. But these are the ones that procrastinate and they do half their assignment and then they decide, well, okay, I'm good with a 50 on this and move on. You really need to do a little bit of this every week. So if you feel up to it, do the first couple of parts this week. And, make sure you do everything in order, by the way. Don't jump from requirement 1 to requirement 4. You're going to make mistakes and get frustrated. All right. Last chance. Do you have any questions for me before I adjourn the session?
Mr. Schaefer, if we use the check my work, does that hurt us in any way?
No,
Okay.
yeah. I'm a little disappointed that they knocked the numbers down on it. Maybe the practice is maybe the homework has more check my works, but students have asked me in the past if I can adjust it, and I can't. The department head controls that.
I didn't know if it was something
No,
that was okay to use.
it's there for your benefit.
Thank you.
And if you use up all your check my work and you're still having difficulty with a problem, reach out to me and I'll send you how to get to the solution. Anything else, you guys? Do you have any Cowboy fans out there? I hope not. My Eagles won big last night. I'm still on a high from that. All right. So again, if you have any questions or you need help, reach out to me. And y'all have a good week. Hope to see you all here next week.
Thank you.